Yeah, it's been some time here. My name is Oluwole Godwin and welcome back to Economics. Hope you didn't miss me too much. Okay, good. Now, today we're talking about accounting profit versus economic profit. The thing is, there are different ways accountants and economists see profit making, and that is the subject of this particular class. Now, how does an accountant record profit, and how does an economist record profit? Now, accounting profit is simply total revenue minus total cost, where total cost contains only the explicit cost. Now we are talking grammars. TR is total revenue, TC is total cost, and TC for an account in calculating accounting profit is only explicit cost. So what are explicit costs? Explicit costs are those costs that you know, the costs incurred in getting something. So that's just the explicit cost. Now, so in order to calculate the profit, the accounting profit of a particular firm, an accountant considers all the cash outflows in buying, raw materials, the payment of salaries, the cost of raw materials, the cost of transporting them, and all of those things. So it's all about the normal cost that everybody is conversant with, which is the money that you use to buy something. So that is explicit cost. Now, so if an accountant to calculate profit is just total revenue minus that explicit cost, so which is otherwise stated as total revenue minus total cost, and that is what everybody basically knows as the way to calculate profit, basically. Okay, so when you say profit, it's all about revenue minus expenses, and that's what this is telling you. This is revenue minus total cost is expenses. So now, and when we talk about expenses, we are spending, to get some things done, whether goods or service, to get some goods or to get a service done. Now, so how does an economist calculate profit that is then different from the way accountants calculate their profit? So an economic profit is calculated as total revenue minus total cost, the same total cost. But here, total cost is equal to the sum of implicit and explicit cost. Implicit and explicit cost. So it is now, and I have to tell you what implicit costs are in case you don't know what implicit costs are. I've already explained explicit cost, the cost that the cost incurred in getting a good or getting a service done, by a firm. So now, what are implicit costs? So implicit costs are a little bit tricky, but the way I define it, from the way I understand it, is implicit cost is the revenue foregone because a firm is not putting its resources into an alternative use. The revenue foregone because a firm is not putting its resources into an alternative use. Now, this is what I mean. Imagine you want to start up a firm and you own a piece of land. So now, if you own a piece of land and you're starting up that firm, if you want to calculate your profits now, it will be your revenue from whatever sales you've made minus cost, your total cost. Now, your total cost will not cover the cost of that land because you didn't buy the land. And that is how an accountant calculates profit basically. But an economist will then come and say, no, you could have sold this land. You would have rented this land out. Okay, so because if you had sold this land, this would have been what you would have earned. Or if you have rented this land out for, let me say, for the period that you used the land to manufacture a particular good or a particular service, you would have generated some rent. Now, the rent that you didn't generate is what is called, that's an example of an implicit cost, or the additional income, the income I didn't generate from selling that piece of land is an example of an implicit cost. Now, let me give you another instance. Now, there is capital as well. Okay, so you could decide to leave your capital in the bank to be earning some interest, or you could put your capital, the capital that you're using to run your business, you could put the capital into financial assets. Maybe you're buying bonds, you're buying treasury bills, you are investing in cryptocurrencies and all of that. So the next alternative use that you could have put your capital into. So what would you have generated if you had put your money to the alternative use? Now, what you could have generated, the additional income that you could have earned, is also an example of an implicit cost. So now this is what economists look at when calculating profit. So they look at it that it is your total revenue minus basically your expenses, what you are spending to get a good or service, an economist looks at it this way, that how do you calculate your profit? Your total revenue minus your expenses, which is basically what you are spending to get a good, that is maybe raw material, or a service, that is the work that your laborers are doing, and other services that are required for the firm to run smoothly. So whatever it is that you are spending on them, then it also adds whatever income that you could have generated from the next best alternative that you could have put your resources into. So when you now put all of those together, that's now constitutes the total cost that an economist look at. So I have an economist looks at. So we have accounting profit. So it's a pie, like a pie. So we use pie to denote profit in economics sometimes, or let's say generally. Now accounting pie, so accounting profit equals total revenue minus total cost. That's equation 1, which is equal to total revenue minus explicit cost. I already explained that. Equation 2. Now economic profit as well is total revenue minus total cost. So you could call this total revenue minus expenses, which is what accountant sees. Accountant just says, okay, what's the profit? Revenue minus expenses. But you don't do that for economics. Okay? Don't do that in economics. Don't say revenue minus expenses, because it is not just expenses, it is more than expenses. So here I can just say revenue minus expenses to get your profit. And for economics profit, they have total revenue minus total cost, equation 3, which is total revenue minus, you open a bracket, explicit cost plus implicit cost. So it's more or less total revenue minus expenses, okay, minus you open a bracket, expenses plus foregone revenue. Okay, plus foregone revenue. So something like that. So it is when you're calculating the economic profits, you have to bring in an additional component. Now the thing is, at the end of the day, TC is bigger in the calculation of economic profit, because this is made up of explicit and implicit costs. It's bigger than that in calculation of economic profit than in calculation of accounting profit. Accounting profit is just this. So TC has this. So by definition, economic profit is smaller than accounting profit. Now because you are also making allowance for implicit costs in the calculation of economic profit will end up being smaller than accounting profit. So by definition, so that is how it goes. Now the thing I want you guys to understand is that accounting profits could be in billions. Could be in billions. You can say, okay, Cadbury made this in this year. MTN made so billion profit in this year and all of that. Okay, and an economist will just come and say, actually, your profit is 0. So it's funny, right? So accountant comes and says, okay, the profit for this particular firm is 5 billion naira. And economist comes, considers everything, checks the implicit cost and all of that, and says, well, this firm is just making normal economic profit. Now we are going to talk about that later on. Normal economic profit. And normal economic profit is just saying that your total cost is equal to your total revenue. So profit in that sense is 0. So when your total cost is equal to your total revenue, let's say 500 million minus 500 million equals 0. But then an accountant says, no, we are making 100 million naira as profit. So when we say, or let me just leave that. Let's get to this point and I will explain that. Now, in terms of economic profit, we have the normal economic profit and we have abnormal economic profit. So I'm saying these are two economic profits now. Okay, so we have normal economic profit or abnormal stroke supernormal economic profit. So it depends on the textbook you are using or the material you're reading. So it could be abnormal, it could be supernormal. Don't confuse yourself. Now, what does normal economic profits mean? It's just like I said earlier. Normal economic profit is normal economic profit simply means that total revenue is equal to your total cost. And so normal economic profit is telling you that your profit, that this firm is just at its break-even point. Okay, now break-even in economics is where your total revenue equals your total cost. So your profit is 0. So when the economist talks about normal economic profit, they are basically telling that your profit is 0. Now, you see, for this to be normal economic profit, for example, this economic profit formula, for this to be normal economic profit, so this could be, let me say, 500 million. Explicit cost will be 400 million, and implicit cost will be 100 million. Now, when you have 500 minus, so 400 plus 100 is 500. So 500 minus 500 will give you 0. So that's normal economic profit. Okay, so normal economic. So the firm is at its break-even point. So economists tells that okay, it is not making profits and it is not making a loss. Okay, so the firm is still doing well reasonably. So maybe you should just, based on whatever is on ground before, maybe you should just continue producing. But at this particular point, so normal economic profit is telling that you're not making a profit, you're not making a loss. Actually, it's economically, because when an accountant comes, for example, as we showed in one of an example above, an accountant will tell you that okay, total revenue is 500 million. It considers only the explicit cost, and then explicit cost is 400 million. as I said earlier. So it doesn't consider this. So at the end of the day, accountant will say 500 million minus 400 million equals 100 million. That okay, this firm is making 100 million naira profit. So it's an economist that will now come and start saying, actually, this business is not thriving as much as you are saying it is thriving, because if you had used this, if you had taken these resources and invested it in this particular line of business, if you had taken your resources and invested it in another industry, you would have generated this additional revenue and all of that. So your firm is not really doing well. Okay, so that's the point. This firm is not really doing, because it is not making any profit, it's not making any loss. So while your accountant makes you happy, makes the shareholders happy, that okay, good, 100 million naira for a start, that's good. An economist probably just makes you moody. You are not making the kind of profit that your accountant says you are making. So, but the thing is it easy to estimate or to calculate what's the next best, the reward from the next best alternative, Is it easy? Because we are talking about opportunity cost here. So how do I value opportunity cost? So how do we value every next best thing that we could have put our resources into? I don't know. So, but there's a way to go about that, and that is just what I really want you to understand, that whatever it is that you could have put your resources in, the next best alternative, whatever you could have, the income could have generated from that place, which are the things that economists look at. Okay, economists look at, and but that's not about that. Now, what's abnormal or supernormal economic profit? Now, this is just telling you that you are making a positive economic profit. Positive. So here, economic profit is 0 because TR equals TC. Now, abnormal or supernormal economic profit is telling that TR is greater than TCR. Your total revenue is greater than your total cost. So it simply means that whatever your total revenue is greater than the sum of explicit and implicit cost. So when your profit is positive economically, the firm is making an abnormal profit or a supernormal profit, or an abnormal economic profit or a supernormal economic profit, or whatever grammar is in whatever textbook that we don't come across, that I have not come across. Basically, if you're reading another text that will mean something else. Now we have an example here. The example says, suppose that the implicit cost for a business is 100,000 and the explicit cost is 500,000, and the firm sold 1,000 units of its product at 600 naira each. So what is the accounting and economic profit? Now the thing is, accounting profit from what we have up there is total revenue. So how do we calculate our total revenue? So let me just write it out. Total revenue minus the explicit and the explicit costs. Okay. So total revenue is equal to price times quantity. And what is the price from this? The price is 600 naira. So we have 600 naira multiplied by the quantity sold is 1,000. So everything gives us 600,000 naira. Now the total revenue is 600,000 naira. The explicit cost is 500,000 from the question. So accounting profit is then 600,000 naira minus 500,000 naira. Okay, and at the end of the day we have 100,000 naira. So this firm is making 100,000 naira accounting profit. Now, what is the economic profit? Economic profit is total revenue as well. We already have our total revenue to be economic profit. Total revenue is 600,000 naira minus, we open a bracket. What is explicit cost? We already have that, 500,000 naira plus what's our implicit cost? We have that from the question, 100,000 naira. 100,000 naira. Okay, so we then have 600,000 minus 500,000 plus 100,000 is 600,000 itself, 600,000. So we then have 0. So this firm is making positive economic profit, but it is barely making this firm is making a positive accounting profit, but it is barely making any economic profit. So the firm is making a normal economic profit, while an accountant says it's making a positive economic profit. Now the thing is, this is not usually this simple, as we'll be talking about stuff like this in another video, in the video that comes after this, where we would have to add some things up in order to get the implicit cost. Now, from the question, you already have what the explicit cost is and what the implicit cost is as well. So there are some questions where you are the one that will add, you would be required to add some things up. You'll be given different data, different numbers, different items. I really want to select which one will go under explicit cost and which one will be categorized under implicit cost. So it's not usually this straightforward, but this is just the basic idea of everything. So in the next video on economic and accounting profits, we'll be talking about those questions, because some of you might be waiting. The video that will release after this should be on Venn diagram. So that was why I said in the next video on economic and accounting profit, we shall talk about questions like that. So thank you very much for sticking around. So once again, this is Economics. If you enjoyed the class, make sure you click the like button and the subscribe button. Once you've done that, you then see a bell appears. Click on that bell. That notifies you when new classes are made available. Alright, tell your friends about us. This is Economics. So you come here, you enjoy yourself, you understand stuff. You are going to be happy that you're sticking around with us. So see you in the next video. Thank you very much. Hope you enjoyed the video you just saw. If you want more of our videos, please make sure you subscribe to the channel and click on the notification bell. Now there is a way to make the best of our YouTube channel, which is to go to the playlist section of every video or of every topic. So what you have to do is just type Economics on YouTube. When the page displays, make sure you subscribe. A bell button appears immediately, so you click on that bell button. Then go to the playlist section. So you are going to see videos, playlists, description, and all of that. So just go to the playlist section, and whatever topic you are looking for, look for the playlist and click on the video. Now our playlists have the classes arranged in a very chronological manner. So if you want to see a class on ISLM, so it starts from the beginning, the simple ones to the difficult to the complex ones. So if you want to see a video on, let's say, elasticity of demand, so you start from what is price elasticity, so from there then to the basic ones and on and on. So I'm just telling you that in case you really want to make the best of this YouTube channel. And there's also one thing that I want to add, which is that our YouTube classes may not be enough for you. You may want a regular interaction with the tutors and all of that. So what you just have to do is to check the description of the video. You are going to find a WhatsApp link. So but before you do that, I really have to tell you that clicking that link is going to lead you to one of our schools. It's going to lead to some of our schools. So we have MOG School of Economics on WhatsApp, and we make use of our YouTube channel to run the groups. So the classes are paid for, so you're meant to pay for them. So to join our Econometrics school, so that is 2,500 naira per month, and to join our Microeconomics or Macroeconomics schools, so that is 2,000 naira per month. We also have we don't have classes, or we don't have schools of mathematical economics, because microeconomics has its mathematical aspects as well as macroeconomics. So the mathematical aspect of macroeconomics is treated in the macroeconomics school, and the mathematical aspect of microeconomics is treated with the microeconomics school as well. So I'll see you next time. Thank you very much for watching.